the Federal Reserve Board in the US continued to bring the pain with yet another rate hike. And this comes in spite of an ongoing banking crisis and an impasse when it comes to raising the debt ceiling, which, if not rectified, could have catastrophic consequences on the US economy and potentially on the worldwide economy. And while they did change their language with respect to further rate hikes down the road, they stopped short of following the Bank of Canada's lead and chose not to hit the pause button full stop. And at this point, it seems that Jerome Powell is unsure as to whether or not he's actually done enough to stop inflation. Well, it's either that or he's just trying to scare the crap out of Americans. And with the ongoing banking crisis, which, let's call a spade, was partially due to interest rates going up faster than expected, the question becomes, does the Federal Reserve Board keep raising interest rates, or does it start to pump the brakes? And if he doesn't start pumping the brakes and higher interest rates are something that we need to become used to for the long term, what exactly should we be doing in order to recession-proof our finances? And that's what I'm going to go through in this video, where we're at the moment, the things that could contribute to a potential recession in the very near future, and how to prepare for it. And no, I'm not going to give you the standard advice of pay down your debt and do all the things that everybody knows they should be doing. I'm actually going to give you real advice on how to survive a recession. But before we get into it, my name is Nolan Mathias, and if you want to thrive financially, this is the place for you. So do me a favor, hit that subscribe button so more people like you can see this video. It helps me a ton to continue making these videos, as it tells the YouTube algorithm, hey, here's somebody who wants to thrive, go find more people just like him. Okay, so obviously the first big topic of conversation here is the fact that the Federal Reserve once again raised interest rates by 1/4 point. Now this was widely expected, but it was also expected that the Federal Reserve would full stop hit the pause button in order to wait and see what would happen with the increases to interest rates that they had already made. Now, Jerome Powell and the Fed stopped short of hitting the pause button, saying that inflation seems to be well entrenched, and as a result, they weren't sure if it was going to be enough to do this one last rate hike and then hit the pause button. So at the moment, where they're at is on a wait-and-see approach. Now, they did change their language substantially around future rate hikes. In the past several months, they had talked quite frequently about the fact that they expected that there was going to need to be further rate increases in order to handle inflation. Now, they very much switched that language this time around, and at this point, they're now suggesting that they are watching to see if further rate hikes would be necessary. So it was a small change in language from we expect it to be needed to now we are watching to see if it will be needed. And Powell went on to say the following: "We on the committee have a view that inflation is going to come down not so quickly," he said. "It will take some time, and in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates." Now, it seems as though what he's suggesting is that rates aren't going to come down anytime soon, and it makes sense that he would be adamant that this wasn't going to happen. The reason why is because the expectation often has as much of an effect on the economy as actually making the rate changes or not making the rate changes. So it seems that Jerome Powell at this moment is doing what many central bankers tend to do, and that is trying not to play his hand. So in other words, creating the expectation that rates aren't going to come down will hopefully change consumer behavior and will encourage them to stop spending at the rate that they have been spending at in order to slow the economy, bring inflation down, and let the rate hikes do their work. So Powell erred on the side of suggesting that, hey, maybe we need to have further interest rate hikes rather than just pulling everything back and saying, hey, we're done, rates could start to come down in the fall, because if he had done that, it could have had an inflationary effect. Now, we don't know exactly what Jerome Powell and the Federal Reserve Board is thinking. We don't know what's going on behind closed doors. It could be very well that they expect that rates are going to have to come down, especially with the banking crisis that's happening, which I'll get to in a second. But they could also very much be expecting that rates won't come down for quite some time. Now, several economists are suggesting that this is the peak of the interest rate hikes in the US. And the reality is only time will tell. But it's clear that the US economy is probably going to find itself somewhere between a hard landing and a soft landing on this one. And in either of those cases, it seems almost certain that there's going to be some form of a recession at significantly higher rates than the last couple. And that again leads to that question that we're going to cover in a couple of minutes, which is how do you prepare for a recession, especially a higher rate environment recession? But before we get into that, I think it's important that we cover two other things that are happening in the American economy that could play a major role in just how hard things are going to be throughout the summer and throughout the rest of the year. Now, the first and the most obvious one is the banking crisis. And at this point, we can call it a banking crisis because that is what it is. We have now had 3 major banks fail, and these are significant banks, especially when you compare them to the size of the banks that failed in 2008. In fact, these 3 banks alone are bigger in total size than all 25 of the banks that failed in 2008. And the most recent, the First Republic Bank failure, is the second biggest bank failure in U.S. history. The only bank failure that was bigger was Washington Mutual Bank, which was worth $432 billion at the time that it failed. Now, that being said, First Republic Bank had assets of $213 billion. Silicon Valley Bank was not far behind it at $209 billion, making it the third biggest bank failure in history. So there's been two of the three biggest bank failures in history in the last 2 months. And many on Wall Street are fearing that the bank crisis is not over. And where this gets interesting is when you start looking at the top US banks and the percentage of uninsured deposits. And as you can see, Silicon Valley Bank had the largest percentage of uninsured deposits of all the major banks in the US. But what's concerning here is that Signature Bank, which also failed, had 89% of their deposits uninsured. And if you go and take a look at the most recent bank that failed, First Republic Bank, they had 67.4% of their deposits that were uninsured. Now, from that, you can kind of extrapolate that there's several other banks that are probably going to find themselves in some sort of trouble in the near future here, especially if they experience any sort of a run on the bank. And my guess is that we're probably going to see at least 2 or 3 other banks on this list fail in the next 6 to 12 months. And further uncertainty in the banking system is obviously a major concern because in 2008, this is what led to the real estate crisis, the financial crisis, and everything bad that happened back then. Because you have to keep in mind, right? It was letting a bank fail that caused the whole thing to collapse. Now, the difference this time around is that the Fed and the FDIC are a little less likely to let banks fail because they know the potential fallout that can happen. But that isn't even the biggest concern that is facing Americans right now. No, the big concern is the fight over the debt ceiling. And the White House put out a report this week that suggested that if the US Treasury misses their payments for even just a couple of days, it could cost 500,000 Americans their jobs. And on top of that, the people who would suffer most if the US government wasn't able to come to an agreement on the debt ceiling is unfortunately the people who need the government the most, those who receive Social Security and many government employees. Now, this debt ceiling problem is something that's completely preventable. All you need is the two sides of the government to agree to extend the debt ceiling. That's it. That's all that needs to happen. But unfortunately, what's happening is you have the White House suggesting that the Republicans are holding the economy hostage, and you have the Republicans suggesting that they aren't going to agree to anything until spending cuts are put into place. So basically, the two sides are suggesting that the other is holding the economy hostage. And the reality here is that all of these politicians are holding the economy hostage. And in efforts to get votes on both sides, they're potentially going to ruin thousands and thousands of lives, which may do a significant amount of the job that Jerome Powell is trying to do if they were to not meet their June 1st deadline and just let the economy go into an outright catastrophe. So then the question then becomes, what do you as a consumer do in order to protect yourself from a recession? And like I said at the beginning, I'm not going to give you a whole bunch of standard pay off your debt, do this and that advice, because that isn't going to be helpful. If you had debt, you probably would have tried to pay it off when interest rates were low, rather than waiting for interest rates to go up and then potentially wait for massive unemployment where you weren't going to have a job in order to pay your bills. So I'm not going to give you the standard advice, but what I am going to tell you is that there's 3 things you can do to help protect yourself at a time when inflation is high, when there's a potential recession, and when interest rates are going up. And they are really quite simple. The 3 things are this. The first thing you need to do is increase your job security. Now, what does that mean? It means making yourself indispensable at work. It means putting in more hours, which, by the way, if you're putting in more hours, might mean more income, which kind of means it has a double-sided effect and could help you earn more money to pay off your debt or do those things that other gurus tell you to do. But the key thing here is that when your company decides that they're going to make cuts, you need to be the last person on the list that they want to cut. So that means you need to work harder than everybody else, you need to show up more than everyone else, and you need to be visible, which means you probably shouldn't be working from home, especially if your boss is working from the office. Now, the second thing that you need to do is lower your run rate. What does that mean? It means the amount of money that has to go out every single month needs to be reduced. And there's lots of ways you can do that. Sometimes it means getting a smaller house if that's possible and reducing your rent or your mortgage payment. Other times it means going from a 2-vehicle family to a 1-vehicle family so you don't have multiple car payments, multiple insurance bills, and multiple gas bills. And of course, it also means looking at all those subscriptions that go through on your credit card and reducing them down to the minimum. And think of this like a diet. Because we all know that we should be on a diet, we all know that we should be trying to lose weight, but it's not until we get to the point where we're embarrassed by the way we look, or the doctor tells us that we're going to die, that we actually make the changes. And unfortunately with finances, it's easy to hide behind credit cards and lines of credit and other consumer debt and make it seem like we're okay financially until we're absolutely not. And then when we go into bankruptcy and we lose our house and our cars, then everyone knows just how bad it got. And it went from seeming like it was okay to being catastrophic pretty much overnight, even though most financial issues are things that happen over years and years and years. So reducing your run rate, reducing the amount of expenses that you have is vitally important. And then last but not least, the third thing you need to do is make sure that you have a backup plan. Now, a backup plan financially can come in several forms. It could be that you have cash in the bank or investments, or maybe even a bunch of gold and silver in the safe. Yeah, I put that in there just for you guys who watch that gold and silver video all the time. But it could also mean having something like a line of credit that's there if you need it. Now, the big thing about having a line of credit, so let's say you don't have any debt, but you also don't have any cash, well, having a line of credit can be a really good emergency fund if you need it, but only if you absolutely need it. And here's the big thing about lines of credit. They're way easier to get before you need it than they are when you actually do. So before we hit that recession, if you have no cash and you have no other significant backup plans available, make sure you start thinking about how you can get that backup plan in place. Oh, and last but not least, the other thing you can do is make sure you're well educated when it comes to your finances. And the best way to do that is by watching one of these videos over here.